Uber stock fell 6% last week after the company reported earnings, and the market's reaction was really kind of crazy. Stock dropped really dramatically and then kind of recovered a little bit, but it looks like generally things are headed lower. Now, keep in mind, Uber stock is up 74% over the past year. So the company is doing extremely well. They've made that transition to profitability, at least on a long-term basis. Seems like margins are getting a little bit better, but you can always quibble with the results. So I want to take a look at the recent quarter and put this into long-term context as to where the company is going strategically. What you want to see with Uber is that they have a growing platform of drivers and riders, people ordering food, all of the other things where Uber can be the connective tissue between those two things. And then that gives you a lot of optionality for growth and even to integrate new technologies like autonomous driving, which is obviously a huge conversation in the market, but isn't really yet reached any sort of scale. Uber, I think, at least has a really solid position in the market because they have that app, they have the user base. And so if we do get some sort of autonomous driving, they could just change out the supply base, which are currently drivers, and leverage the users that they already have. But let's get into the quarter, and I'm going to start with what the market's reaction was. This is the stock market's performance for Uber over the past year. You can see the shares are up 74%. But on the decline, at least in the short term, 12% over the past month, peaked at right about $82 per share. So definitely not moving in the right direction right now, but let's look at the recent results. Trips grew 21% year over year. Monthly active customers up 15%. Bookings grew 20% year over year. So everything looks like it's headed in the right direction, even operating income positive. Uber's definitely turned the corner in that respect, not burning money like it was when it first went public. And the operating cash flow was $1.4 billion with free cash flow of $1.4 billion as well. This is a look at the key metrics for Uber, and these are the things that you want to see growing when you're building a platform company like Uber. You want to have more riders, particularly on the demand side. I think supply will kind of solve itself in a lot of different ways. But if you have the riders, then you have people who are willing to pay for your services, and that's going to attract drivers. So that was up 15% year over year. Trips up 21%, and this is where you see the huge jump in gross bookings of 20%. Revenue for the quarter, the way that Uber works is they generate revenue from what they take from each ride. So if a ride is $10 and $8 goes to the driver and $2 goes to Uber, they're going to generate $2 worth of revenue. So I think that's always important to think about, that there's actually a lot more money going through the ecosystem, but what Uber recognizes as revenue is just their portion of each ride. So that was $10.1 billion, obviously moved from an operating loss to a profit in the quarter. And they had a net loss of $654 million. But again, this goes to the details in a quarterly report. If you look at the second note here, what they say is they had a $320 million benefit related to Uber's equity investments. What you need to do as a company now is mark to market on your equity investment. So if you own stock, for example, you're not just going to hold that on the balance sheet at the value that you bought it at. You need to change the value to what the market price is on a quarterly basis. So you had a benefit there in Q1 2023 and then in Q1 2024. So this quarter, you had a $721 million loss from equity investments. So that accounts for more than all of the net loss for Uber. They would have been profitable without that. The other thing that I think is really interesting with Uber, we still oftentimes think of this as a rideshare company, but nearly half of their revenue is now coming from deliveries. So that has been a huge business, allows them to leverage the number of drivers that they have. And again, this is one of those things where if we go to something like autonomy, having that infrastructure of deliveries, I think is going to be extremely valuable because now you can plug in off-peak hours. This is primarily food deliveries, but you could deliver all kinds of things, especially if you have autonomous vehicles. So just something to think about as we look at what the future of Uber looks like. Now, as big as deliveries are, the money is still made in mobility. This is adjusted EBITDA, about 3 times as profitable as the delivery business. Now, Uber does have $9.5 billion worth of debt on the balance sheet. That's offset by about $6.5 billion worth of cash and investments. So solid balance sheet, but maybe not perfect given the fact that Uber has traditionally not been making money, but now that we are free cash flow positive with Uber, would like to see this debt number decline and get to a net cash positive position. They also have a significant amount of stock-based compensation, $484 million in the quarter, so about a $2 billion run rate. But that obviously impacts the cash flow statement because those expenses are on the income statement, but you pull it out when you get to cash flow. So that's where you get the $1.4 billion worth of cash from operating activities. So things are moving in the right direction, but I think it's just a question of how profitable is Uber going to be able to be, and are they going to be able to live up to this $140 billion valuation plus the $10 billion in debt. It's $150 billion enterprise value, excluding the cash that's on the balance sheet. So that's a lot for a company that just recently got to profitability. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Strategically, I think Uber is headed in the right direction. They're really containing their costs well. The company's continuing to grow. If they can keep growing at a double-digit rate, that's going to be really impressive given the scale that they already have in the market. The question is really about valuation. And just go through some of the numbers. This is according to FinChat. The price to earnings multiple on a trailing basis is 108. So I'm talking about a very expensive company on a forward basis even. So based on analyst estimates, the price to earnings multiple is 40. So that's really expensive when you're looking at projected profitability over the next year. Price to sales, or enterprise value to sales, is nearly 4. And on a forward basis, it's 3.2. Now, if there was more leverage in Uber's business, you might expect a little bit higher enterprise value to sales multiple, but there is a lot of infrastructure and physical cost that goes into running Uber. So I think that's why you don't necessarily get the same software multiple that you might get from a price to sales perspective. But from a strategic perspective, I think it's pretty clear that Uber has won the rideshare market, and that's probably not going to change in the future. Lyft is going to ebb and flow over time. I think it would actually be good for Uber if there were still 2 options in the market and they didn't just have a monopoly power. That would probably bring a lot more scrutiny to not only their regulatory position, but also their pricing. From a strategic perspective, the challenge is going to be, is anybody else going to be able to build some sort of an autonomous system that could rival Uber or even partner with Uber? They have partnered with Waymo in Phoenix, so it'll be very interesting to see how that rolls out. I think it would make sense long-term for Uber to eventually merge with Waymo, but that could be 5 or 10 years down the road. It isn't really clear what Alphabet's business model when it comes to Waymo. So that may take quite a while to play out. They may have to force their hand if somebody else gets into the market, like a Tesla or like a Cruise. But generally, I think Uber's in a really, really solid position. The question that I have is just simply valuation. And I think this is just too much right now to pay for a stock. You have a lot of downside risk. If you do get margins falling, if people stop riding, if somebody builds some sort of autonomous ride-sharing network, those would all be huge risks. And when you're paying a huge multiple for a company, those are usually downside risks. And there's not a lot of upside potential, just continuing operations the way that they are. So that's the way that I'm thinking about Uber right now. Great company, doesn't have to be a great stock. And that's the case with a lot of these growth tech companies right now, is that they're just priced really, really highly, priced to perfection. And at the end of the day, that's what's going to keep me out of Uber, at least for now. But I'm going to keep an eye on it because I love the strategic position that they have in ride sharing. What do you think about Uber's results? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.